Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. How do you get the benefits of broad diversification while also potentially juicing up your return by adding high momentum stocks? Now, diversification is something I've been advocating for many years, and if you're a regular listener here, you know that's something that comes up in almost every episode, especially recently, as certain asset classes like energy have outperformed the broader market by a wide margin, while others, like technology, are underperforming. And investors have different takes on broad diversification. Some believe it's just boring, as it doesn't generate those eye-popping returns that you might get with a home run in a single stock. Think about those meme stocks from about a year or so ago, right? But in today's show, we talk about ways to evaluate single stocks from both a value and momentum standpoint, and how to incorporate those stocks into a broader portfolio with built-in diversification. What mistakes do investors typically make when trying to implement a portfolio using single stocks? Today, I cover all that with my guest, Sean Bonner. He's the founder of Guild Financial. Sean has a background both as an institutional portfolio manager and as a naval officer, and both of those are relevant to what he's doing today at Guild. Guild is especially aimed at the military community, but as Sean tells us today, it's open to absolutely all investors. Sean discusses why it's so important to know exactly what you're buying and selling and why it's in your portfolio, whether it's growth, value, or a momentum stock. And he discusses the core and satellite approach, which many professional investors use, and how you can also build a portfolio around a broad-based ETF like the S&P 500 and then add alpha with single stocks from there. Sean has a lot of other tips, like how to diversify in a small account and the wisdom of holding assets with low correlations to one another. As you can tell, lots of gold here today, and there is also an Air Force-Navy rivalry joke thrown in for good measure. Here's my interview with Sean Bonner of Guild Financial. All right, Sean, great to have you on the show today. From your perspective, and we were just talking before I hit the record button there that you were recently overseas. You said that gave you a little more perspective on what's going on globally with inflation. What do you believe retail investors may be missing right now when it comes to an understanding of how the markets work and what is actually going on in this current environment?
Yeah, thanks, Kate. And this is, truly a unique environment, right, in terms of inflation and sort of the economic position that the country's in. It's something we haven't seen in a long, long time, probably something since the early 80s. You know, the recent inflation data came out at 8.3%, down from 8.5. We have a CPI number coming out tomorrow. It's expected to be that high again. So this is, these are historically high times for inflation. So you see the Federal Reserve, right, who kind of controls the flow of money in this country, all of a sudden reversing course, raising interest rates instead of lowering interest rates, reducing their balance sheet instead of expanding it. So these terms get thrown around like soft landing and hard landing, right? So what does that mean? Anyone who's, been on a commercial airliner knows what a hard landing versus a soft landing.
Right.
And, I'm a Navy veteran. In the Navy, they talk about how, the Air Force knows soft landing because they land on nice smooth runways at airfields, and Navy aviators slam the jet down on the boat because that's how they have to get it down. So that's the ultimate hard landing. But the hard landing, I'm sure
any Air Force or Navy veterans who are listening to this are getting a chuckle out of that one.
Yeah, exactly. Well, Top Gun just came out, so we got to get it in there, right? But, there's kind of soft landing, hard landing talk. It's how's the Fed going to be able to rein in the economy, rein in inflation without putting the economy into recession, right? So if the Fed acts too strongly, it's too hawkish, raises rates too fast, they could potentially push the economy into recession. And then we'll have high inflation and a recession, right? The soft landing is sort of the Goldilocks scenario, which the Fed's been able to do really over the last 20 years, but this feels different this time.
Okay. And what do you think retail investors may be missing or not understanding? Is there anything?
I think, look, a little bit of short-term pain, I think, is the idea, right? Whether it is a soft landing, a little bit of short-term pain in the economy, meaning slowing growth is a good thing for the long term, right? These inflation numbers are unsustainable. Anyone who's been to the grocery store or the gas station in the last couple of weeks, right, certainly feels it. But also, as a retail investor, you can understand like those are the sectors that are doing well, right? And those are the sectors you should kind of be thinking about. The U.S. consumer's in pretty good shape, but if we kind of get one of these bad scenarios where the Fed is raising rates and we see the economy start to shrink, start to not expand as fast as it was, but inflation being stubborn and not coming down, that's when we get into stagflation. And that gets to be a bit nasty, right? That's kind of late 1970s, early 1980s when, Paul Volcker had to raise rates overnight to 20%, right? That's not a scenario anyone wants to think about.
Absolutely not. And I think we're in a much more of a hyper-political environment these days than back then. But that's a whole other question. What did you see maybe in your overseas trip that also changed your perspective here, Sean?
Yeah, so this is going to be a little unique, and I certainly have a unique perspective. And my career, we were talking a little bit, I spent some time in the Navy Reserve as an intelligence officer, as well as my time working on Wall Street and being a portfolio manager. And this company that we have, Guild, is sort of the combination of that. We're built for the military community, but open to anyone. But we also have a foundation associated with that. And our mission really is to support the military community, first with financial education, but kind of really anywhere they are. So, with the war in Ukraine kicking off, we saw a major deployment of troops out of the 82nd Airborne in North Carolina over to Poland. And so we had, a short notice, right? Families disrupted, 3,500 troops sent over there. And so, for us, that's where our community was. So myself and one of my co-founders, Kaj Larson, former Navy SEAL, we went over to Poland to see for ourselves and see what we could do to help out. And then, of course, once we got boots on the ground in Poland, we quickly learned that there's a large U.S. military veteran community actually in Ukraine, volunteering on the front lines and volunteering in support roles. So that's where we went next. So I just returned 3 days ago from my second trip to the Ukraine. And, I saw firsthand, one, why they call it the breadbasket of Europe. So that kind of central region of sort of Ternopil to Kyiv, from the central part of the country. I mean, this time of year, it's probably one of the most beautiful places on earth, right? It's like you're driving through a sea of green, oceans, green fields. These farmlands just go as far as the eye can see to the horizon on both sides. But sadly, a lot of those fields are now mined, and a lot of those farmers are now fighting on the front lines, right? So that's going to affect the harvest there. So you've got 10% of global wheat comes out of the Ukraine. You've got 14% of global soy comes out of Ukraine. And you got 50% of global sunflower oil out of the Ukraine. So that harvest coming offline, that yield being diminished directly impacts the supply of food stocks and a major factor in inflation. So not only will it, in fact, impact inflation numbers here, but also affect food security in the Middle East and in Africa, which would cause a whole other set of problems.
Oh, no kidding. As you're speaking, I pulled up the chart for an ETF that I have been tracking for several months now. You may be familiar with this one as well, Sean. WEAT. It's the WEAT ETF. And
Yep.
This has shown monthly gains every month since February. And it's got a pretty significant year-to-date gain so far for the reasons you just outlined. So even though there's tragedy occurring, and neither one of us wants to minimize that, there are opportunities, though, aren't there, if investors are smart about it?
Yeah, I mean, absolutely. You have to pay attention to prices, right? Whether the prices of stocks or prices of commodities. One of the first things that really didn't get talked about when the invasion kicked off is that, kind of front month wheat contract went hyperbolic, right? It broke out of a range it hadn't seen in, years and years and years. But, wheat, soy, sunflower, they're a little bit different than oil, right? Oil's in the ground. You have to go find it and you pull it out. But you've got this kind of continual harvest with these agricultural products. So ag's a bit different. So it kind of remains to be seen what's going to happen with the next harvest and the harvest after that and the harvest after that. I think that is sort of a big question mark, right, for inflation going forward, right? How are food prices, food stocks going to look because you've got a major source of global supply offline or maybe coming back online? So, but it's not like, all of a sudden you get in, you put the pipe in the ground and it comes out, right? You've got to have a continual production working in the land to be able to achieve that supply.
Right. And it does come back to the question of risk and reward being related for investors. And you're absolutely right. With all the uncertainty, sometimes that is exactly where you get your return, but it can also tank your return. So that's investing.
That's absolutely right. I was at the Berkshire Hathaway meeting this year. Warren Buffett used one of his famous quotes. He likes to recycle, right? What makes sense at one price is ridiculous at another.
Yeah.
So, I think while we're looking at oil, I think at over $120 a barrel now, and, global food prices high, I think that, if depending on what your view of the situation and the companies are, there's definitely still opportunity in those sectors for sure.
There are. So let me follow up on that. And let's just talk about what you're seeing through your role at Guild and what you're seeing with the investors. How are you seeing the investors navigating this bear market? I mean, what trends are you noticing, Sean, either good or bad in terms of how people are handling this?
So the Guild platform itself is pretty unique, right? We are built on this idea of transparency and collective intelligence. So like we don't have to wonder and kind of, or any of our members on the platform don't have to wonder. We actually have a collective intelligence crowdsourced portfolio that's updated on a daily basis. And that's the 30 most popular stocks that appear on our platform in real time in the actual percentage weightings that our members hold them. So like I'm looking at the crowdsourced portfolio now. The top stock and it's Apple at roughly 15% of the portfolio. It's been that way for a while. And we've got kind of a mix, and we've had a mix sort of from the beginning of this year of some kind of momentum-y based stocks, right? Some of the high flyers like Rivian, like you'd think too, because we probably have a little bit of younger demographic based on the military and based on that we're a mobile app too. But we actually have some really surprising stocks on here. One of the ones that's been on here since the beginning is the Schwab TIPS ETF. Even before, while inflation was still being called transitory, that appeared on our crowdsourced portfolio. And then we've got, some other stocks on here, like you wouldn't necessarily think that, a sort of, younger tech first crowd would be thinking of, but Builders First, Southern Copper, Tractor Supply, Costco. So we've got kind of a mix of, sort of consumer staples, some tech, and then some really interesting ones like that Schwab TIP ETF. Another one that just popped on is the BDRY ETF, which is the bulk rate dry shipping ETF. Talking about, I guess, people thinking about global supply chain issues and what do those global shipping rates look like. So it's been a really interesting sort of, experiment looking at this. And I've been impressed with the sort of diversification of the portfolio and, names I really wouldn't have ever thought of. So there's a lot of information to be pulled out of this.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. Well, let me ask you something about that, because I agree with you. It's fascinating to kind of see where people are gravitating towards. But is there any kind of danger in gravitating towards what's popular, and I'm using air quotes here that nobody but Sean can see, instead of seeking out what might be a better opportunity rather than just a stock that seems trendy? Does that make sense?
No, it makes perfect sense. Look, I spent a long time as a 5-star value manager, right? Large cap value. So, by definition, we're trying to go where other people aren't, or, the kind of thrown away stocks. But by the same time, there's a lot of research that talks about momentum investing and momentum stocks, how they can provide significant return. And I think we've got a nice mix on here. So yeah, right, that's sort of the big question. How much momentum's too momentum, right? If you believe in the company, if you believe in the business, and the financials can make sense in some realm, I think there's nothing wrong with momentum stocks and momentum investing if you believe in the growth story. Now, look, I've made a living out of relative value too, right? And I was at first a big buyer of Apple for the fund I ran in 2012. And we ran a value fund because it showed up as a value company, right? With all the cash it had on the balance sheet and the operating income it generated. I mean, it was literally the world's largest ATM. So, just because when you think of a company and you look at that's a tech company, it doesn't necessarily mean it's a momentum stock, right? Or it's got no fundamentals to it from the value side. But yeah, momentum investing, I think, ran smack dab into some hard realities come this year, right? So you had inflation and war all of a sudden make some of these momentum stocks have to all take a step back and logically look at their multiples. And then those multiples got cut in half. And in some cases, then got cut in half again.
Do you think that retail investors maybe err on the side of looking at the story or the potential? Like I'm thinking about something named Rivian, and I don't want to pick on Rivian. I'm just using it as an example here. But, I'm looking at the chart. There's no earnings forecast for this year or next year. The stock it's above its low from May, but it's still pretty far down there. So is that maybe a case of people looking to the future of EVs rather than what's going on right now? And I'm just going to add.
I hope they're looking to the future because their computer's broken if they think they're buying it on, fundamentals today. But no,
yeah.
I think that's a great point, right? I think that is something that retail investors miss. So I'm a big believer sort of in the Munger Buffett mantra of, right, I'd rather buy a good company at a fair price than a fair company at a good price, right? So meaning the first thing you have to do is buy a good company. And I think retail investors are really good at that, right? They look at Rivian, they look at all this technology, they know the future of EVs there, right? Or they look at, some latest kind of soft good clothing line and it's got great traction and everyone's wearing it. I think where retail investors need to do the kind of that second piece of work is like, what is a fair price? Because there's a difference between a fair price and a ridiculous price, right? So buying the good businesses and buying kind of, name brands and business brands that have vision, I think retail investors are great at spotting those. I think it's on the kind of valuation side. And it's, for momentum stocks where there's no really earnings anyway, it's hard to kind of figure out the momentum figure out the, what the appropriate multiple would be. But at least to have some kind of glide path to like, there's going to be some kind of operating income here one day, right?
Right.
What it would have to look like.
Right.
You got a point where Tesla was trading at, over 1,000. Right. And it was like, okay, it's, bigger than every car company put together times, whatever since cars were invented.
Right. Exactly. And, these things do come and go. I mean, one thing that comes to mind is I think all the excitement over cannabis stocks a few years ago. And to some degree, it still exists, but those things have never bounced back and have not really yet lived up to the potential that the story would have you believe, have they?
Yeah. And again, right, it's like the idea of, cannabis is going to be widespread and people are going to use it and legalization, means a lot of help for people that need it medicinally. But like, what is the actual business model of these companies, right? Like, where do they generate their operating revenue? What's their expense structures look like? That's where like even just a little bit of research, a little bit of work on, publicly available Google or Yahoo Finance could help. And you can sort of, paint a picture for yourself, right, of where these stocks are trading, the price that you're paying, because you're owning a piece of the company. You're owning a piece of the earnings today and then your earnings down the road. Well, what is that actually that you're buying?
So let me ask you this, because you're a former portfolio manager, you understand how the pros analyze a stock to include in a portfolio. How do you suggest individual investors go about this? Because obviously you can't do the same kind of research that a Wall Street research team would do. So what should the individual investor do?
Well, first, I'll say that's probably a good thing, right? I think retail investors have significant advantages over institutional professional portfolio managers. One is they don't have to get worried about week to week or month to month performance, right? As a professional, if you've underperformed by 60 basis points over the last month, right, you're going to be answering a lot of emails. And I mean underperform versus your benchmark. Retail investors tend to, be a little more forgiving themselves, which I think is good, will help them in the long term. So, but I think the number one problem with most retail investors, and the data sort of pulls it out, most retail investors have like between 5 and 8 stocks in their portfolio, right? They don't have any sort of diversification. And when you look deeper into their portfolios, they have 5 stocks, and 3 of them are all in the same sector, right? So they've got too much concentration, which, from 2012 to, the beginning of the pandemic looked great, right? You're concentrated, the market's going up and these stocks are going along with it, right? You've got a high beta portfolio that's a little more concentrated than you would think it would be. That's a good thing. But, we get the pandemic and then we get, the scenario that we're in now. People, once again, are having to look at the benefits of diversification.
Yeah, that's exactly right. And I'm actually a former advisor myself. I owned an RIA for several years. And I know that one of the things that advisors say across the board is broad diversification, stay the course. Depending on your philosophy, you might want to tilt toward value. You might want to tilt toward small cap. But I think that's sometimes frustrating for people, isn't it? Because you see something there that's not working and you're like, well, why am I still in this? So what is your thought on that type of diversification, Sean?
Yeah, look, if it's not working, it's not working, right? The market's telling you something. If you're in a stock that's not working, you better have pretty good conviction about it, right? And that's Look, I always say if you hate your kids, raise them to be value managers because you're usually buying something that's going down and going to stay down for a while, and you're going to take a lot of abuse for it. But unless you're prepared sort of to live that life, I think looking at sort of the fundamentals of a company, understanding really what it is you're buying at the end of the day. If just because, an advisor tells you to buy this stock and stay the course, but it's massively underperforming all the time, like the market's telling you something about it, right? Mm-hmm. So should have more conviction than someone's advice to you over that. At the same time, too, when you're looking at your portfolio, right, look at it in a couple different ways. Look at it some sector diversification. Look at it in types of stocks they are. Are they tech stocks? Are they momentum stocks? Are they value stocks, right? A little bit of diversification can go a long, long way. And making sure that, the 5 or 10 or 15 stocks you have now aren't that highly correlated. And I think that's one of the benefits of kind of the new mobile apps, including ours, have come along, offer commission-free investing in fractional shares, right? So now for a small dollar amount, you can be pretty well diversified.
Yeah, that's true. And that is something that people wonder about is how do I do this if I'm only starting with 10,000 or even less sometimes? So do you see clients that you have with even smaller accounts that are able to begin diversifying properly?
Oh, sure. I mean, we've got, in the kind of military theme, we actually have a diversification ribbon, a diversification award for people on our platform that have 10 or more stocks in their portfolio. So you get a ribbon that looks like a military ribbon, and actually it's sort of modeled on the Army Good Conduct Medal, right? Because we think diversification is good conduct. Yeah, but when you can buy increments of a dollar of a stock, right? You can, with $10, you can have a 10 stock portfolio and be at least minimally diversified. So yeah, we see plenty of $100, $200 portfolios with pretty good diversification in them. And then of course, right, there's always that one stock or one ETF you can buy that provides instant diversification. And that's a broad-based ETF like the Spider S&P 500. And from that, one of the things I like to preach, especially to retail investors, because, managing a big 30, 40 stock, 50 stock portfolio, which for a professional is very small and concentrated, right? If you're, a large cap mutual fund, a 40 stock portfolio is very concentrated. But for a retail investor, an individual, that's a lot to keep track of. So I like to preach the core satellite investing methodology, right? Look, put a bunch of money into the S&P 500, the SPY, right? Buy that core ETF. You're going to get market performance. You're going to pay very, very little for it, right? That's what you're guaranteed. And by definition, you've got diversification. Although that can kind of be argued now since sort of the top 10 market cap weighted stocks and they're all pretty heavily tech, consists of, overweights in tech now. But, get yourself diversified by buying that ETF and then satellites around it, right? Buying individual plays you like around it, some individual stocks. So, if you put 60, 70% of your assets in kind of that core broad-based market ETF, then you got another, 30, 40% you can buy a Rivian with, you can buy some Tesla with, you can buy Tractor Supply, right? Based on how you feel. But you've always got that kind of core piece delivering you market performance, right? And then you can seek to 1, get more diversified, 2, offset some risk, and 3, try and get some increased return from these satellite investments. And it's something that we see certainly big public pension plans and professional sort of investors that have to allocate across different asset classes really, really follow that core satellite approach.
Yeah, that's interesting. And it seems that when you are adding the satellite positions there, maybe you could take a little more risk with some of those, some stocks with a little higher beta. Could that possibly be a strategy?
Yeah, absolutely. I mean, we sort of equate in the military sense, we sort of equate the core satellite approach to, like, if you think about the core part would be big Navy, right? So think about surface ships, think about aircraft carriers and destroyers and submarines. And then the satellite approach is like, our Navy SEALs or our, underwater technicians, the EODs, right? All these really micro kind of specialized jobs that get in and get out of places quickly, right? You can trade in and out of them quickly. They do specific jobs. They train for specific jobs, but big Navy is always there kind of to give you that core protection, right? The way the S&P 500 could do for your portfolio.
That's a great analogy. I really like that one a lot. That makes a lot of sense intuitively, Sean, to think about it that way. Hey, now that you've brought up a military analogy there, I want to give the listeners a chance to learn more about Guild and what you're doing over there. Talk about that for just a minute and then let us know how we can find you.
Sure. Yeah, so we launched this in Guild as an mobile-only investment app. We were in beta, launched on Veterans Day, and then came out of beta in January. It's myself and 2 other co-founders, all former Navy officers. So we're an all veteran-owned and operated team. So you can find us on the App Store, Guild Financial, and the website for us is guild.financial, and that's the whole domain. We are sort of from the military for the military, but open to anyone. And the reason why we're open to anyone, unlike USAA, is we know that the more members we have on Guild, the more resources we'll have to be able to fulfill our mission to serve this military community and help them secure their financial freedom. And a big way we do that is through financial education, right? So that's really the second leg. One is access to investing with commission-free and fractional shares, but also basic financial education and basic financial education that people can actually take advantage of. You know, I'm old enough to remember in home ec, right? You used to get like basics on like how to fill out a tax form. This is what a check is. This is what a routing number is. People don't get that anymore. The younger generations don't get that anymore. We see these young kids, you know, trained to drive $1 billion submarine, ultra bright, super early adopters of technology, but you know, they just have never had the basics in financials, right? So like they use Venmo or they use the Cash App, but they barely will even keep money in a savings account. So it's kind of hard to get them to understand, like, no, you know, this is the basics of the financial system, and this is kind of what you need to do. So we have basic investing modules. The first one is on just investings versus savings. And again, we've got this collective intelligence and transparency piece to it. You come on the app, everyone gets a username. Now you can choose to share your profile with the community or not. But every day we rack and stack everybody on performance, daily, weekly, and monthly. So you can see, you know, somebody's username at the top. Like if you look at me, I'm Guild 1 Actual. You can see whenever I fall in the top 10 of the leaderboard, you can look at me, you can click on my portfolio and see exactly how I have my portfolio allocated, all in percentages. So you don't see any personal information. Right. You don't see any actual notional dollar sizes. You just see things in percentages. But that's really a kind of a good corollary to the collective intelligence portfolio, right? It's like if you think about Yelp, you got the star rating at the top, which everybody likes, but people want to see those individual reviews, and that's our leaderboards. So it's a unique experience, I think, for investing, and I think it's the way certainly the market's going with the sharing economy. So we're happy to be a part of it.
Yeah, that's really interesting. And we will certainly link up that URL in the show notes. Hey, Sean, thank you so much for joining the show today. This has been interesting, very unique perspective on the market, helping a very specific segment of the population. But as you said, open to absolutely every investor. So that's great.
You got it, Kate. Thanks so much.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.